Hello, in this video we are going to look at how the stock market has performed during periods of rising interest rates. There's a lot of false information out there. You will see it almost treated as fact that if interest rates are going to rise and inflation is creeping into the economy, that is going to be bad for stocks. And we actually find, if we look at the data, that the opposite is true. Stocks actually tend to rise during periods of rising interest rates, and we have this on the chart here. But when we kind of dig into the data even more and look at how we would potentially use this, we find that maybe interest rates just aren't that useful for predicting stocks at all. Whether it's that they're going to go higher when interest rates are going up or they're going to go down, it's just not a super useful tool, because it's just almost like a coin flip. Sometimes it works, sometimes it doesn't. Sometimes you have to hold through a big decline while you're waiting for what you expect to happen. So while there is an upward bias in the stock market when interest rates are rising, it may not be super useful for trading. So that's what we're going to cover in this video, just real quick, showing you. We have the S&P 500, which is the little green and red. These are monthly candles, so we're seeing quite a bit of data here. 1995 over on this side of the chart up till close to the end of 2023 on this side of the chart. I have marked off certain sections where interest rates started to rise. Interest rates are the orange line, and they are on this scale over here, so going from 0% up to 6.5% on this axis. So recently, let's look at that one first. 2022 to 2023. Interest rates started increasing. Stocks initially dropped a fair bit, more than 22%, but then quickly recovered as prices or as interest rates kept rising. This ended up almost being exactly flat. So over this period, if you had bought at the start of rising rates and sold now when they've leveled off, you'd basically be flat to maybe up just slightly more recently. So that was a flat period, but again, was it that useful? Maybe not, because you had to hold through this big decline if you believed in this upward bias. Do all people want to hold through a 22% decline? Well, that's up to you and your investing strategy, but it's maybe not ideal. Here in 2016 to 2019, we had rising rates and a very definite upside move basically that entire time. While interest rates were rising, stocks also rising. Same with 2004 to 2006. Interest rates very sharply rising and a definite upward bias in stock prices over that couple years. Looking at this period, late 1999 into 2000, you have a period of increasing rates there. Stocks, very definite rise during that period. So at this point, we start to think, well, maybe prices always rise, but no, that is not the case. There are some periods where prices tend to drop when interest rates are rising. One notable one here in the 70s, you have a very sharp rise in interest rates in 73, 74, and a very noticeable decline in stock prices. This period here, you have a very marked rise in interest rates. This is going from 1976 to about 1980. Initially, stock prices drop. Again, this is a couple years of falling prices as rates rise, but then stock prices rebound as rates continue to rise. So overall, this was a very flat period for stocks, where they dropped initially when rates started to increase, but then rallied back as rates got even higher. So we see the examples over and over again where there does seem to be a bit of an upward bias, but is it that useful? In 1987, rates were rising basically right up until the 87 crash, and then when that happened, rates dropped again, and then we see this upward period following the 87 crash when prices rose and interest rates rose. So again, was this super useful? If you just stayed invested this entire time, you would have had to hold through one of the worst few days in stock market history. And yes, the prices eventually recovered as interest rates dropped and then recovered. So this actually has a couple little areas where rates rose and dropped in this period. But overall, when we look at all the data, there is an upward bias, but again, it's not super useful for just making a blanket statement that says, well, as long as rates are going to increase, I'm just going to hold the stock market, because we can get these big drops, and even if the price does eventually recover, maybe we don't want to be holding through these declines. So what I think the bigger takeaway is that interest rates probably not the most useful tool for analyzing the stock market. Over the long term, the S&P 500 has risen. It has a long-term upward bias, and I think that's the bigger takeaway. When we factor in that, it's not super surprising that stocks tend to rebound and increase over time, because that has been their long-term bias. I prefer simply looking at the price action and trusting the price action of the index and not being as worried.